G'day, Alan Kohler here with the weekly Facebook live stream. It's great to see you. Thanks for joining me. Here we are again, and remember the live stream is general advice. My answers may not be appropriate for you. And here we are back in the swing of the year, so it's great to be in that, and plenty of questions again. It's great to see this, and I wanted to mention that we're doing a Constant Investor Live. So we're going to do an experiment. We'll see how it goes. We're going to do one, it's in March. We're just preparing, just organising the date, but it'll be a panel in Melbourne to start with, but if that works, we'll take it around the country and we'll kind of come to each state and do a panel session to answer your questions on a broad range of investing topics, and it'll be specially for members. Probably won't be free for members, but certainly not very cheap, and for non-members much more expensive. So I just thought I'd mention that. I'll probably have more details on that in the week or so ahead, just to tell you who's on the panel and how it's going to work. But I'm sure you'll like it. Now, I should really get struck straight into the questions, because we've got a few. So first one, Craig asks, I listened to your interview with Structural Monitoring Systems Director Mike Reveley. I'm a long-term holder and a bit bewildered by its current share price, given what the company has achieved to date. I would be interested to know your thoughts on the company after interviewing Mike. Yeah, well, trouble with interviews is that you don't actually, learn everything about the business. It's good. You have to talk to the CEO, or in that case, he was the COO. I didn't get the CEO of SMN, who was Toby Chandler, but I got Mike. He was fine. They're all in the US, including Mike. It's a US company, really. Started off here, but they're all now in the US. But look, I have been making some inquiries, and this is a very interesting situation, which I think is worth talking about a bit, because it's a classic situation where the product of the company is a lot better than the governance of the company. The problem with this business, and it did come out in the interview, if you go back and look at it, the governance of this business has been terrible for years, and I think basically it still is. And the problem with the share price is that the company and the management are not really trusted. However, that might actually represent a bit of an opportunity, because the product is great, and it's been picked up by Delta Airlines, and they are using it, and it is going to work to identify metal fatigue and so on. So the product is fine. The problem is the governance of the company, and in some cases, that's basically fatal. Poor governance, no matter how good the product is a reason to stay away from a company. And that may be the case here, but possibly not. And I just note, and I didn't know this before the interview, but it is worth knowing that they had a capital raising last year at $1.25, which was 3 times oversubscribed, because the share price was quite low. It's still around about $1.15, $1.16, I think. Now, as I understand it, Toby Chandler, the CEO, took up as much of that capital raising as he could, and he put all his family and his friends into it. So I think there's a possibility that that the board and the management of this company wanted the share price to be low last year and now, so that they could, buy stock. I'm not sure about that, but I think it's a possibility, and so therefore that would suggest that it's a good opportunity to buy, if that's correct. I mean, the trouble is I'm not sure about it, and really all you can be sure of is that the product is good, and is going to work, and is going to be successful, and so I think, Craig, you shouldn't be too worried. I think you're in a good company. you should stick with it. Certainly don't sell now, because you'd effectively be selling to management. And the last thing anyone would want to do is sell your shares to management, because that suggests, because management always knows more than you do about a company, and if these blokes, Toby Chandler and them, are buying, then you shouldn't be selling, I reckon. That's basically what I think. And if management is buying, as they seem to be here, then maybe you should buy some too. So look, this is one of, as I say, this is one of those situations where the governance could present an opportunity for a long-term buyer who's prepared. I mean, it still could take another couple of years for it to turn into cash. So you still have to be patient. I'm not saying for a moment that it's going to, go back up to $4 or whatever it was straight away. But look, I think, I think in the 1 to 2 year time frame, there's no reason why this can't be a good, solid cash-earning company. And I'd say that probably they need to change management and move on, get some more, that maybe Toby Chandler and them have been good for getting the company to this point, but they need to have another set of management to take it forward. So, and I think that certainly would be a signal to buy. If they change the management, change the board in any way, set the company up for the future, I reckon that would be a tremendous buy signal. David says, Happy New Year, Alan. The Dow is up 320 points overnight and we are up 0.03%. What's wrong with the Oz share market? So there are a couple of questions on similar lines. Clearly the reason the Dow is up so much overnight was because the US dollar fell a lot last night. I think it went down 1% last night, and continues the decline that's been going on for more than 12 months now. So the US dollar is down 13% over 12 months now, and there are a couple of questions on that subject. So I'll deal with that. I think it's very interesting. Robert says the US dollar trade index has been falling sharply since the start of 2017. What's driving that decline? Matthew also wants to know about the US dollar falling against most currencies at a time of unwinding QE and Trump fiscal policies that you would assume would be pro-inflation, which you would think would lead to the Fed moving rates higher. Also, says Matthew, you'd assume that this would lead to more inflows into the US, or is it the case that the unwinding of QE and the fact that it hasn't been done before and we're in uncharted waters means that the conventional economic principles don't apply? And then Barry also wants to know about the ASX lacking momentum versus Wall Street. So look, just before we get on to the dollar, this situation, the currency situation, I mean, there is also the element of the Australian banks. So the banks and the financials in Australia represent a very large proportion of the index. I think if you add property trusts, in particular retail property trusts, we're talking 35% of the index. And banks have got headwinds. Interest rates, long-term interest rates are rising. So a lot of the Australian market, and it isn't just those banks and the REITs, a lot of the Australian market is a yield-based market. And as interest rates rise, that is a headwind for the Australian market. And long-term interest rates are rising. That's definitely the case. So I think that the number one reason the Australian share market is underperforming the US is that we're very much a yield market now. Used to be a commodities market, but now much more so a yield market. And therefore, our share prices are going to come under pressure as interest rates rise. And I'm talking about long-term interest rates, not the Fed funds rate. And there's been a huge rise in the 2-year bond rate in the US, 5-year bond rate, and also the 10-year bond rate is also rising, but not as much as the 2-year rate. And that 2-year rate, I think, is really significant, for yield stocks. So as I say, that's the number one reason. The other reason is the US dollar, which is falling, and that is benefiting American companies at the expense of the Australian companies, because the Australian dollar is rising versus the US dollar. I think it's probably up to 81 cents today, I would say. I haven't looked yet, to be honest. 80.7. So look, Yeah, the Australian dollar is rising. It hasn't yet broken out of the long-term trend line. It's been rising for 2.5 years, the Australian dollar. So that's another headwind for Australian businesses. Now, so then the question is, well, how come the US dollar is declining, as it has been all year? The US dollar went up after Trump was elected, but really since December, it's been in decline. And I think this is a very interesting phenomenon, and because the share market has been tremendously strong all year, partly because of the declining dollar, but not entirely. And the distinction I drew, I think, in the overview last week, was that the share market is focused on earnings per share, but the dollar and the interest rates are more of a macroeconomic market. They're more interested in the macroeconomy, not specifically earnings per share. And I think what you're seeing now is a split, in a way, between the prospects, the EPS, the earnings per share prospects of companies, which are getting boosted by the tax cut proposal from 35 to 21% in the US, huge tax cut, which is going to lift earnings across the board in the US. But I think that the markets believe, and I agree, that the tax cut is bad for the macroeconomy. And that's because of the blowout in debt. I mean, the Joint Congressional Taxation Committee estimates that the net cost of the tax cut over 10 years is $10 trillion or something, some ridiculous number, maybe it's $1 trillion. Anyway, it's a lot of money, and it's going to blow out the budget. Now, in the early 1980s, we saw something very similar when Ronald Reagan cut taxes, which blew out the budget deficit in those years. It was tremendous for companies. The Dow Jones in those years, the early 1980s, from 1980 to 1985, went up a lot, doubled. The Dow Jones doubled, but the US dollar halved over that time. Huge fall in the US dollar because of the tax cuts, and because it was known to be bad for the economy. And so I think that's what we're seeing again. The US dollar is responding to the perceived problem of the budget deficit blowing out, the difficulties, the problems with Trump's administration in general, apart from the tax cut. Obviously, it's a pretty chaotic administration. So I think what you're seeing is two markets perceiving Trump and what's going on quite differently. The stock market seeing it as positive because earnings per share get the uplift from the tax cuts, and the bond market and the currency markets perceiving what's going on there as being negative. And I reckon that's got a fair way to go, to be honest. I think, as things unfold in the US, the US dollar is going to keep falling, and possibly the bond rates will continue to rise. Certainly the dollar will continue to fall, and I think any investing that we do should not be predicated on the Australian dollar falling. Now, a year ago, everyone thought the Australian dollar was going to fall, go back to 70 cents, even below that. I think, obviously, it didn't happen, and it's now at 80. And I think that it's going to keep going up. I'm not sure. I'm not saying it'll go back to parity or something, but I think it'll keep going up. So Barry's further question is, this probably means the top 20 stocks will lag again. So which stocks should one concentrate on? And he says A2 Milk, Kogan, WiseTech, etc. And the answer is yes. This is a time for stock pickers. ETFs are not going to perform. Australian ETFs are not going to do well. I think the other thing to point out is that the other part of the reason the US dollar is falling is that the European and Japanese economies are doing well, much better than America's. And so the euro and the Japanese yen are rising very strongly, and that's, obviously currencies are relative prices. The US dollar is falling relative to the euro and the yen. So if you're into ETFs, Europe and Japan are probably the places to be. The currency markets are telling you that those economies are going really well. And so, but apart from that, it's about stock picks, you know, and it's a matter of looking at what's going on in the world, you know, where are the, and that's what I'm trying to do with the interviews, is kind of identify interesting companies. So we've interviewed A2 Milk, we've interviewed Kogan. I haven't interviewed WiseTech yet, but will do. I think that's a really interesting business. It's gone really well, and I think it was well raised there, Barry. WiseTech, I think it was a good point. But yes, look, lots of interesting stocks on the ASX. Certainly, you're going to do better finding them, identifying themes that you're interested in, that you think will do well, and focusing on them, rather than just buying the market, because I think the banks have got headwinds. Interest rates, governance problems, Royal Commission on Banking, and so on. Duncan says, "G'day Duncan, thanks for joining us again. Who are the juiciest interviews you'd like to line up in 2018? It's probably time to talk to Richard Umbers again at Myer, seeing what's going on there, which is not great. The interviews that I'd really like to do are those where the companies are doing badly, because they're on the back foot. But look, I think we need to do more this year. As I said the other day in the overview, we need to identify more good, solid yield stocks for you. I think there are a few of those. I'm thinking of calling this series of interviews Fully Franked, because what really we're interested in are fully franked dividends, because they're so much more attractive, and if you can get 5% fully franked, that's a really good yield. So I think we need to find more of those and understand more about how solid the company is and what the dividend paying potential of them is. Other than that, I interviewed the other day, I think we're going to publish it tomorrow, the CEO of MyPhysic, MYQ is the code, and it was one of the best performing stocks last year. It went from 3 cents in October to $1.50 now. Well, heavens above, that's unbelievable. And so it's a really interesting interview. The bloke's name is Vlado Bosanac. The company's based in Perth, and it makes an app for iPhones. Really worth listening to that interview. But another really hot stock, big performer from last year, is called Bubs, which is another infant formula business like A2 Milk, except it's tiny, but it's based in Sydney, seems to have a decent brand. It's starting to sell infant formula, so I'll put in a request from them. I think that's pretty juicy too. So plenty to do this year. Fair dinkum, I could do 3 interviews a day, not 1. I just haven't got time. There's so many interesting stories out there. This morning I interviewed this company called Tawana Resources, which is in a lithium business, and they've pre-sold 5 years worth of lithium out of a mine near Kambalda in Western Australia, as well as tantalum, which I thought was pronounced tantalum. In fact, I still think it might be tantalum, but anyway, he called it, this bloke, what's his name? Mark Calderwood, who's the CEO of Tawana Resources. He calls it tantalum. Anyway, they've got lithium and tantalum, all pre-sold. Mine starts up in March. Stock's been flying. There's so much there's so many interviews, Duncan. I just don't know where to start or stop. I could, as I say, I could do them all day, every day, and still not really do more than scratch the surface. John says, one of your tips many years ago, ORE, which stands for Orocobre, has done well. Thank you for that. What is your current thinking on them? Orocobre is obviously one of the big lithium miners. It's a South American producer. I can't remember where the mine is. I think it's either Argentina or Peru or somewhere. And they produce the lithium from brine, which is what they do in South America. We're in Australia, we've got hard rock producers. Orocobre, one of the world's big producers. It's kind of one of the what you'd call a heavyweight in that field, and I think if you're looking to invest in lithium, it's hard to go past Orocobre, but I would say a lot of the potential of the company is in the price now. So I'm not entirely sure where it's at. Let me just have a look on my trusty Iris screen here. So it's basically 690. It's up, 690 it was 6 months ago, $3. So yes, it's done very well lately. As to how much of it's in the price now, I don't know. I think that there are probably some better growth opportunities in lithium than that, and I'll try to bring them to you. One of them is Tawana Resources that I mentioned just before. Mark Calderwood. They've got Orocobre's got a market cap of 1.7 billion, which is pretty big. Tawana Resources, for example, has 250 million market cap, and they're about to announce a resource upgrade in the next quarter, which the CEO says will probably lead to another big increase in the share price. So my new tip is Tawana Resources. There you go, TAW. I think it's TAW. Is the thing, is the quote. If you're interested in lithium, I'd have a look at that. Listen to the interview, which won't be on the site until Monday. So you're getting an early scoop on that interview. Tawana Resources. I'll just check the code for you. Tawana, is that right? Yeah, TAW. TAW is the code. 49 cents, market cap 250, and it was. Hang on, I'll just look up what the price has done. So because it's done a fair bit lately, yeah. Well, 2 years ago, the stock was 3 cents. Now it's 50 cents. So it's a bit of a 10-bagger, but it's probably got more in it. Anyway, that's Monday's interview. Tomorrow's interview is MyPhysic, which is obviously done a fair bit already because it's $1.50 and it was 3 cents. Not very long ago, but this bloke Vlado Bozrak reckons there's plenty left in that stock as well. So there you go. Marty says, "G'day, Marty. Great to have a question from you. Do you have any knowledge of how the new tax rates in the US will affect companies who use the tax-deferred system? I heard that QBE said that they would be adversely affected." And she's also asking about URF, which I think URF stands for the US Masters Fund, I think. Anyway, QBE did announce that the reduction in the tax rate in the US from 35 to 21% would mean that they had to write off $230 million from the value of their deferred. It's actually an asset, the deferred tax. Well, they've got a deferred tax asset which they're going to have to write down by $230 million. And so yes, so QBE has been adversely affected by that. I have absolutely no idea what's going on, what the US Masters Fund situation is. Obviously, US companies will benefit from the tax cut, but those who have a tax-deferred asset will, like QBE, will lose out a bit because the value of that asset declines with the tax rate. But I really don't know about US Masters Fund. I've had a brief look on their website, and there's no sign of any statement about that. So I can't really help you. Maybe they'll put something out in the near future. Roger says, "I've just read your column in The Australian on cryptocurrencies. Surely they offer a couple of benefits that fiat currencies do not. Firstly, they are very hard to trace, which gives significant value for those circumventing the law. And secondly, because unlike fiat money, it's not continually devalued by issuing more." What do you think about that? Okay. The first thing is, I don't think that the use of cryptocurrencies and Bitcoin in particular for circumventing the law is a good thing for them. I reckon that all of them want to become legitimate, and they're all in the game. All the people who are behind these currencies, promoting them, are trying for them to become, proper, legitimate payment systems and the future of money. And the last thing they want is for the things to be taken over and completely in the hands of money launderers. So look, I guess they are a bit more useful for those people, for those money launderers. But I tell you what, they've been doing okay with fiat currencies. I read the other day, and I've put it in the research and diversions part of my overview. The world's wealthy people have 10% of world GDP sitting in tax havens. So that's quite a lot of money. I mean, I reckon that they're doing okay. So without Bitcoin and cryptocurrencies. So the second issue about not issuing more, well, there's a bloody initial coin offering every day. I mean, there's more. There are something like 1,450 cryptocurrencies now, growing by the minute. So it is true that the number of bitcoins is limited to 21 million. That's true, and only, I think, about 17 million have been issued so far. However, if you look at the universe of cryptocurrencies, it's growing all the time. There's actually certainly being printed, more of those being printed than fiat currencies at the moment, for sure, in total. And with bitcoins, people are buying fractions of them. I mean, the fact that there's 21 million a limit of 21 million bitcoins, it seems to me, not being an absolute geek on this subject, that limit of 21 million is kind of irrelevant. People are buying, 1/100th of a bitcoin or 1,000th of a bitcoin and spending it. So really, it doesn't matter. I mean, crikey, you could divide it up into 1/1,000,000th of a bitcoin eventually, so that there'll be not 21 million bitcoins, but 21 billion bits of bitcoin, if I can put it that way. So I don't think that the issuing of fiat currencies versus the non-issuing of cryptocurrencies is an issue. I think it's irrelevant, which is probably one of the reasons that the price will crash at some point of these cryptocurrencies, because everyone will realise that it's rubbish, and the price will come down. Which is not to say that the whole thing will go away. I don't think that the cryptocurrencies will go to nothing, zero. But I think that. And anyway, the other thing is that the question. I don't think these cryptocurrencies will ever become the future of money, because by definition, once the governments accept them as money, they become fiat. And you can't. I can't see. Maybe I'm wrong here, but I can't see how money can be separated from governments. I don't see how you can have a monetary system that is not, in some way, controlled by the government, because money is, in a sense, an extension of government now. If we move to a non-government monetary system, whether it's Bitcoin or Ripple or Ethereum or whatever, where we're all being paid in ethers or ripples and spending them at the supermarket and living our lives in a monetary system that is not dollars but bitcoins or whatever, then that is a massive change to society. I mean, that just if governments aren't running the monetary system anymore, then the place has been turned upside down, and I think that is such a big change, it's probably not going to happen. Anyway. So David says, you recently mentioned the use of lithium, nickel and cobalt in batteries and EVs, but surely of bigger use is copper for the windings of electric motors that drive EVs. Good point, David. I suppose people aren't really focusing on copper as a battery component, or at least an electric vehicle component, because there's so many other uses for copper. It's a smaller proportion of the total demand for copper than for lithium and cobalt in particular. Nickel also, there's a broader demand. So although the nickel price has been going up in response to electric vehicle demand, it's much more kind of dispersed because of all the other uses of nickel and copper, I would say. So in terms of investing, if you're interested in kind of focusing on electric vehicles, probably better sticking to lithium and cobalt. But you're right, though. Of course, plenty of copper is going to be used, and maybe by the time we get to, every vehicle on the road being electric, the demand for copper will be sky high, and it really will have an impact on the market. So I think that's probably something to bear in mind. Thank you for that, David. Andrew says, I'm currently investing in QRE as per current market timing newsletter. However, it has zero lending percentage on CommSec margin lending. As a diversified ETF, I would have thought it would have an extension value around 65 to 70%. Are there any alternatives to QRE that can be used? I don't know, to be honest. You're talking about, I presume you're talking about a geared alternative to QRE, which I just simply don't know about. So what's QRE is the Beta Shares Resources Sector ETF. Right. Okay. Well, I'll have to look into that for you, Andrew. I just don't know whether. I mean, I suppose you could do your own borrowing if you wanted to. I mean, it's just a thought, but I'll have a look, see if there are any alternatives to the Beta Shares Resources ETF that's geared. So you're obviously a bit of a risk taker, Andrew. You're looking to make a bit more money than they can give you ungeared. Fair enough. William says, Alan, would you comment on the APN Outdoor Group and put them on your future interview list? I was attracted to them when the merger was in play, but scotched by the ACCC. They seem to be just bouncing around ever since. Okay, they'll go on the list. It's a pretty crowded list, as I was indicating before. Not quite sure when I'll get to it. I don't know. I can't really comment on it at the moment. I don't know enough about it, but I'll definitely put them on the list. Jay says, what's your view on Domain? Good question. Robert also says, with Domain and McGrath Limited, respective boards having major board members and key management personnel resigning, do you think this is a canary in the coal mine signal for property owner occupied and investment properties? I do note that clearance rates in Sydney are nearly falling under 60%, roughly 25% owner occupied. 75% of investment properties are interest only, with prepayments to increase by 50%. And Australia has, with a population of 24 million, approximately 479 construction cranes in operation, compared to the United States with a population of 323 million and has 194 construction cranes in operation. Really? Well, that's amazing, Robert. I didn't know that. That's a very interesting statistic. 194 cranes across the United States. That's hard to believe, to be honest. But if it's right, then all I can say is wow. That we have about, a third of the number of cranes in Australia, 3 times the number of cranes in Australia compared to the entire United States. And as you say, we have 24 million people and they've got 323 million. So all right, let's just take that at face value. That's incredible. There is has been a huge boom in the construction of apartments, especially in Sydney. And as far as I can tell, supply and demand remain in balance of apartments. I think that, as Tony Abbott pointed out the other day, if you want to make housing more affordable, you need to cut immigration. And the reason that there's so many apartments and being built is to handle the big amount of immigration that Australia has. So that's one thing. But as for Domain and McGrath, which is the original part of the question, I think it's really worth bearing in mind that Domain and McGrath make their money not from house prices, but from the listings. Now, obviously, prices have some effect because the vendors of houses are paying both Domain or McGrath a fair bit of money to market the houses for them, to sell them. So if the price comes down, then they're possibly going to be less inclined to spend that money or as much money. But really we're talking not much here. You know, like we're talking, so if prices come down, say 10%, that's not going to make much difference to them in terms of the amount that people are prepared to spend on selling their houses. What affects the Domain and McGrath revenues is the number of listings, and perversely, as the property market declines, the number of listings goes up because more and more people are trying to sell their house. That's what's driving the price down. And so the reason the price is going up, the reason the prices have been going up, is because there haven't been many people listing their houses. There hasn't been a lot of supply. And that's why those companies are in trouble, particularly McGrath. But Domain's been doing okay because they've been taking some market share off REA, and it's, you know, it's a slightly more complicated business. Nevertheless, the fundamental driver of revenue for Domain and realestate.com, REA, and McGrath, all the real estate agents, is the number of listings of houses and the numbers being sold. And really, counterintuitively, that increases as the market declines. And so, and it really increases if there's a property crash, because if there's a property crash, everyone's putting their house on the market and trying to sell it, and the real estate agents are cleaning up. In particular, the online ones, Domain and REA, because you have to pay up front. With people like McGrath, real estate agents like McGrath, they get paid when the thing's sold. And so, in a sense, McGrath gets double whammied because there aren't that many listings at the moment, and they only get paid when it's sold. So if the house doesn't get sold, and it is getting more difficult to sell, it's even harder for them to make money. Whereas Domain and REA will make money up front because they get paid for the advertisement or the listing going on the site. So look, having said all that, I reckon what's happened in Domain is shocking. I mean, Anthony Catalano is a kind of friend of mine. An associate, an acquaintance. I know him anyway. I mean, I was his first boss at The Age, and I gave him the job as property editor at The Age, which he then translated into becoming CEO of Domain, which is not bad. So look, and I've always liked him. He's a good guy. He's got 8 kids, would you believe, through, I think, 3 marriages. So he's, he's a prolific sort of character. But I think it's terrible what's happened there, really. I mean, if I was a Domain shareholder, I'd be absolutely furious. I mean, they've bought in on the assumption that Anthony Catalano is going to be around, and bugger me, he quits. So I think that's terrible. I wouldn't be surprised at all if there was a class action, because shareholders have been misinformed. And I tell you what, there wouldn't need to be a paper trail that suggests that anyone knew that he was going to resign when they listed the business. You know, there wouldn't want to be. I mean, it really ought to be, or better be, come out of the blue. That he's just woken up one morning and said, "Crikey, I can't go on. They want me to move to Sydney, and I can't do it." And by the way, I also think that's rubbish. He doesn't have to move to Sydney. God, the Domain can be based in Melbourne. I mean, it doesn't matter where it is. It doesn't matter where he lives. I mean, Highwood's been CEO of Fairfax for years, and he's always lived in Melbourne. He's just commuted backwards and forwards. So that's, it seems to me, also rubbish. Rachel says, final question here. Rachel says, any initial thoughts on the newly negotiated TPP, Trans-Pacific Partnership, Part 2 without America? No, sorry, Rachel, I don't. I mean, I haven't had a chance to look at the detail of it. I don't know whether it's any different to the original one. You know, I think a lot of these things are kind of political grandstanding. It'll probably benefit rural exporters, and that's good. I mean, it might, in terms of listed companies, Australian Agricultural Company might do well. Some of the dairy companies like Bega and A2 Milk might do well. So look, you know, I think it's, yeah, but I'll have a look at it, but I just don't know yet. And we are out of time. Today's CEO, speaking of rural companies, is Mark Palmquist of GrainCorp, which is a pretty volatile business. They've had a terrible harvest in 2017, which has been combined with good harvests everywhere else, which has meant the prices come down. So for Australia's wheat industry, it's been a double whammy. We've had a bad harvest and the price has been low because everyone else has had a good harvest. So that's been terrible. But so, you know, GrainCorp's price has been down, but I think it's worth listening to Mark because this may be the low point, you know. And GrainCorp, I can't remember. I think it's not a bad yield. This GrainCorp is a part of my New Year resolution to do more interviews with dividend-paying stocks. So GrainCorp's yield is 4%, but it's fully franked, and you might get some capital growth because they're at a low point now because they had a bad harvest. So interesting and well worth listening to Mark Palmquist, who is today's interview. Once again, the disclaimer, general advice today may not be appropriate for you, so just bear that in mind if you wouldn't mind. And I'll see you at the same time next week, 1 o'clock. Be there or be square. See ya, thanks.